Hi, welcome to Numerix Video Blog. I'm your host, Jim Jockle. Joining me today, Kevin McPartlin, Managing Director of Greenwich Associates. Kevin, how are you?
Great, how are you?
So you might have seen it on LinkedIn yesterday, a new report from Greenwich Associates on the buy-side FX trading desk by the numbers. So at the top level, let's break this down. Average desk size, 8 people. Total people budget, $30.9 million, and a total tech budget of $19.8 million per year. So what's the background that's led to this?
Sure, yeah. So we interviewed just shy of 100 investors, FX investors around the world to understand what their desks looked like, how they worked, where they spent their money. So a couple of top-level trends, about 3/4 of FX volume done by the buy side is done electronically. It's one of the most electronic markets that we cover, although I think we've hit a ceiling there, so we haven't seen much growth, but again, still one of the most electronic markets that we cover. The real change, the top line numbers haven't changed all that much, but what's really been changing is growth in the use of execution algorithms by the buy side. You would think, given how electronic the market was, that their use would be widespread, but until recently, they were not. And then the other big focus has been around data and analytics, so transaction cost analysis, both pre-trade and post-trade, and to a lesser extent, sort of during the trade, has become a real big focus for the buy side as they focus more and more on best execution and sourcing liquidity from a variety of new places.
So in terms of the 3/4 that are fully electronified, what's the balance and the barrier to the remaining volumes?
Well, so most of what's still done over the phone is complex orders and large size orders. In most markets that have a sizable amount of electronic trading, that is the case. There's a human element that will never go away. If you want to buy a house or a car, you still want to talk to somebody for the most part. You want to go to the deal. You want to work with a broker. Same is true in capital markets. If the order is large, you want somebody who is an expert who spends their days doing this to help you along the way to make sure you're making those right choices. And even from a fiduciary perspective for some asset managers, ensuring that you're having those conversations and can show your client, your end client, your investors that you're doing the right thing is tremendously important.
So arguably as a very mature market in terms of electronic trading, what other areas are now starting to dabble? Last week we had a conversation here at Numerix looking at structured products distribution and the electronification of that particular market as we're starting to see more volumes and pickup in Europe. Where do you see the orders of priority utilizing FX as a benchmark?
Yeah, sure. So I think there's one thing that's worth noting, right? We talk about electronic trading and electronification. It's a little bit semantics, but I think there are two separate things. When we think electronic trading, their minds go to high-speed order book trading, like in equities or in futures. Whereas electronification is more, we're taking a process that was very manual before and applying technology to make it more efficient. So, in markets where you're doing sort of a traditional request for quote, which is a lot of FX, structured products as well, we should encourage that. That's still a really good positive step forward. It makes sense given the product nature and the liquidity profile of those markets. But a lot of folks would say, no, that's not sort of electronic trading in the traditional sense, but it's certainly electronification, which we do believe is a good thing and should be encouraged.
Now let's drill down on an average desk size of 8 people. Is that a trend that we've seen, kind of downward trend, less people on the desk because of different automation processes?
Yeah, I mean, over time, the buy side has seen their desk sizes shrink. The sell side has as well. In both cases, it's an efficiency play. Whereas the sell side is getting hit by new regulations and reduced profit margins, and they're having to become more efficient. The buy side is hit by fee wars, moving to passive rather than active management, where they can't make as much money unless they're doing huge volumes. So they're trying to figure out how to make their desk be more efficient, and a huge way to do that is investing in technology. That goes back to the $20 million or so spent annually on tech. If we look at the fixed income market, it's a great example because that's evolving so quickly towards electronic trading. The shift of budget has moved year over year from people more and more into technology. which just wasn't the case 4 or 5 years ago.
Now, in terms of the budget spend, it would be remiss if we didn't talk about the general trend of market making moving to the buy side. How is that going to influence some of these elements in terms of spend and management?
Sure. So I take some exception to saying the buy side are market makers. What we've actually seen is the buy side is price makers, right? So if you can come to the market for a bond or even a structured FX product and say, this is the price I'm willing to trade this at, is anybody interested? To me, that's fundamentally different than a market maker whose sole purpose and way of making money is to provide continuous two-sided quotes and help other folks trade throughout the day. And that's not how the buy side makes their money. But yeah, certainly they're coming forward more and more as price makers. We're seeing that particularly in corporate bonds, where it's a very new thing. But while it sounds radical, think about the equity market. Really what you're doing is putting in a limit order, right? A limit order is saying, I want to buy IBM at $100 a share. Is anybody interested? That doesn't seem odd in equities. It does seem odd in some of these OTC markets, but I think we'll see more of that.
And last question for you, in terms of that $19.8 million tech spend, how much of that is ring fence in terms of R&D? Are we seeing any elements of innovation? I mean, obviously AI is the talk of the town, big data, things of that nature. How much, if any, is getting to new technologies in terms of FX?
Yeah, so a lot more and more of the buy side is looking to third-party software providers to provide them a lot of their technology. So I think a lot of that innovation is being done, in the vendor community, working very closely with their big buy side clients. The two biggest spends in that 20 million are their market data desktop, right? So FactSet, Bloomberg, Reuters, and their OMS. Which is really like the command center for their day-to-day. And then there's other stuff in there about hardware and analytics, as we spoke about, and such. But that again, that's where the innovation is happening, is the partnerships they have with those vendors to sort of bring in enhanced features and help make their day-to-day life easier.
So just one other question that you kind of invoked in me. When you look at JP Morgan's tech spend of, say, 600 billion annually, do you see tech spending increasing in the buy side, given these new technologies and almost a new role in some cases?
Yeah, I think we've seen, and this has been going on probably for 20 years, and I can't believe we've been in the industry that long, but probably for 20 years, where you've just seen a skill set shift, where in some cases you don't necessarily have less people, but rather than having Harvard MBAs or finance majors, you're having PhDs in math and computer science that are spending more time to create those algos and automate more processes. On the sell side, tech spend, I find it pretty interesting, is in the 90s when we were in the first dot-com boom, banks were spending and spending and spending on tech and wanted to be tech companies. The bubble burst, they decided, wait a second, we're not tech companies, we shouldn't do that anymore. And now it almost feels like we're getting back to where we were, where banks are realizing, hey, actually we do need to be technology companies. That's where our competition is. Well,
there's been a lot of recent reports in terms of Goldman Sachs kind of leveraging its technology platform, SecDB. Same thing with JP Morgan and Athene, and it's starting this debate again.
Yeah. I mean, I think we shouldn't minimize the importance of relationships, especially at the institutional level. The retail conversation, I think, is different, but the institutional level, relationships still matter, and having people that can help to work with clients and navigate complex situations, that's not going to go away. But yeah, making those people smarter with technology is the only way forward.
Well, Kevin, I want to thank you so much for joining us. And again, of course, the report is the Buy Side FX Trading Desk by the numbers, available on GreenwichAssociates.com. And I want to thank you for joining us. Of course, we want to talk about the topics you want to talk about. Follow us on LinkedIn and at Twitter at NX Analytics. I'm Jim Jockel. Thank you very much.